Welcome in, folks. It's a buy one, get three free in this one here today. 4 videos for me to react to. The first one up here, Dan Ives went on CNBC a couple hours ago. Going to react to this one here. The AI party has already begun. Yes, sir, it sure has, okay? Then we'll react to this one. Centauri Fund, Dan Niles. Magnificent 7 stock should be renamed the Fantastic 4. Okay, looking forward to getting into that one in this video, reacting to that, kind of sharing my opinions. Adam Pitapaka, tired of people whining about all that matters. This is a Max 7. Okay, that should be an interesting one. And then, what is this? Is this a bearish video? Equities will likely bottom by mid-October. Holy smokers, that's no dang jokers, okay? I'm looking forward to getting to that one. Appreciate y'all joining me as always. All I ask in return, smash that thumbs up button and make sure you're subscribed here to the channel, okay? Once you've done those 2 things, we can go ahead and we can get into this video here today, okay? And by the way, if you're part of my Patreon and you have more than 5 figures in your portfolio, make sure you get your award and get into the Hall of Fame there. That is available in the Discord chat, and it's absolutely complimentary. I send those awards for free. So just something to keep in mind there. If you're looking to join my Patreon, see the stocks I bought here today, plus support my content, then check out the pinned comment down there in this video, okay? All right, guys, let's get into this.
You keep using 95 as an analog for where we are roughly right now. Can you talk about that?
And not 99.
Right.
And I think that's the important thing, is that it's because of the monetization. The spending that's happened with the godfather of AI, Jensen, NVIDIA, that's just the start. Now the second, third, fourth derivatives, we think for every $1 of spend on a GPU, there can now be a multiplier of $10, $12. You think about that multiplier into software, into chips, I believe the AI party has already begun.
Are you going to ignore any kind of inventory corrections, even if they're short and shallow, on a quarterly basis? You're just going to ride this for the next 5 years?
Look, and I'll be in Asia in the next 2 weeks, so we're going to have to navigate around it. And you have some supply issues, regulatory, but ultimately, when we look to where this is all going, I mean, I'd say we're in the dugout to first inning.
Not even the batter's box.
Not even the batter's box relative to the overall AI revolution. And even though we started here from the godfather of AI, Jensen, it's now, you see what's happened in Redmond. You look what's happening at Google. Look at Amazon. You look at names like MongoDB, Palantir. Now investors are focused on, okay, who's the second, third, fourth derivative, which is why we believe that this tech bull market has a lot of legs going to 24, 25.
Can you explain the multiplier effect for our viewers and exactly where you see that filtering, and also kind of the time frame by which it filters through? Because that's important here, given just the, as you mentioned, we're in the batter's box of monetization. So how soon can you really see that multiplier effect trickle into earnings?
That's why Kramer talks about Taylor Swift moment for tech. And I agree as a Taylor Swift moment, because what's happened, you look at that dollar for GPUs. Now, Copilot. You got to go to Microsoft, build out the foundation. What does that do to what's happened? Redmond, we saw that in the earnings. Then the use cases. How do you actually deploy in the use cases? Mongo, Palantir, Snowflake, data. You start to go down the list. The multiplier for every $1 of the GPU, now it's the software ecosystem. And this is really going to bring a tidal wave to spend on software for, I'd say, infrastructure, and then you look at services, and I think that's why a lot of these stocks, people will talk about it's a bubble, 99. I disagree. Some of that covered tech stocks back then can't even compare relative to valuations, balance sheets, and monetization. And that's what.
So I love to listen to conference calls of even stocks I don't own. And the reason I'll do that is I pick up information that essentially, I just wouldn't have otherwise, right? And so Snowflake's a stock I don't personally own, but a lot of times I'll listen to their conference calls. And so this was probably 6 months ago or so. I was listening to a Snowflake conference call, and the CEO and I believe it was COO was on the conference call. And they were they were basically asked, like, when do we, NVIDIA's seeing all this, ramp up in demand in terms of the hardware side. When do we see it on the software side? And the executive said, listen, you're going to see that more in 2024 and beyond, right? And so when it comes to the AI demand more on the not chip-related side, let's just call it that, it's really a 2024 and beyond story. And so for those companies like the Palantirs, or if you want to throw the Snowflakes, and I don't cover the MongoDB company, but if you want to talk about those companies, it's really 2024 and beyond is when you really start to see the ramp up in the spend for those specific companies, okay? So just something important to keep in mind.
Monetization's happening, and we believe the AI revolution, it's a get out the popcorn moment. I'm not saying you're not going to have some little speed bumps here and there relative to where we see this year.
More broadly, within Mag 7, there's some discussion today about Tesla, Apple underperformance within that group. How are you thinking about that?
Well, I think for Apple, we're just about to get that renaissance of growth. I mean, I talk about iPhones as just a tip relative to on the services side, and we believe the AI app store that Cook will talk about and unveil, WWDC, as well as AI in terms of exclusive LLMs in iPhone 16. This is now going to be the renaissance of growth at Apple from what an AI perspective. And also iPhones, we continue to believe, not roses and champagne in Beijing, but we're starting to see a stabilization post the new year. Tesla, it's definitely a white knuckle period. But we continue to believe on the other side of that is the growth, is the AI piece, is demand, where I still believe right now the street, I think underestimating what demand could be.
So for Apple specific, there's something big about to happen, and it has nothing to do with AI. Okay, the big thing that's about to happen for Apple is in about, we can call it 7, 8 months from now, Apple's going to show off their next iPhone. Now, the big thing is it's supposed to be a bigger iPhone. And so we're likely going to see a super cycle in iPhone next year. If you look back, every single time Apple ever makes a bigger iPhone, it's just always crazy demand. I can't tell you why. Maybe just people really love the newer, bigger iPhones. But from my understanding, it's going to be bigger versions, and I'm telling you, it's going to freaking sell. And so that's the big thing for Apple for next year. Obviously, you're not going to really see it reflected in obviously the numbers they report this year, because it's not going to be in the market, right? But in terms of the numbers next year, you're going to really see it in quite a substantial way. And I think that's good for them. This AI stuff, their new product they have out in the market, in the Vision Pro product, right? A lot of talk and things like that. I've heard of people already returning those. And, I told you my opinion on that. I don't need to go back into that. But nonetheless, if it's a super cycle for iPhone next year, it's going to be very good for Apple stock. Next one up here, Magnificent 7 should be renamed the Fantastic 4.
And then it should be rebranded the Fantastic 4. On that list, Meta, Amazon, Microsoft, and NVIDIA. That stock pointing more gains in the pre-market this morning. This after a 16% spike yesterday, juicing markets all around the world. Joining us right now, Dan Niles, founder and senior portfolio manager of the Satori Fund. Good morning to you. I was going with the Fancy 4. Fancy 4.
I like the word fancy.
Well, I'm a superhero fan, so I had to go with the Fantastic Four. So what can I tell you?
I hear you. But why don't you just explain why you're taking 3 off the list? I'm curious about, actually.
Well, I think if you look at the last 2 years, really stock prices were driven by the Fed. So you go back to 2022, the Fantastic or the Magnificent 7, as they called them, were down 46% during that period of time. And that was because we had the fastest rate hikes in history, had very little to do with earnings. You go back to last year, the Magnificent 7 were up 111% over that same period of time. Again, not really earnings driven. Every stock went up because Fed was on hold. People were at one point expecting up to 7 rate cuts. And so multiples expanded across the board and stocks ripped. Right now, where you are is earnings seem to be driving a differentiation among these names. So Apple, after they reported their December quarter, estimates went down again from March. For Tesla, similar situation. And if you look at Google in that group, they did well in their AI-related business, Google Cloud, but their big business, which is search, which is what they're known for, and YouTube, both of those categories missed. Meanwhile, you had Meta blowing out numbers. If you look at those 3 that I dropped off the list, that's what they all have in common. The earnings are struggling. They're having issues with competition. And I think you're seeing that in the stock prices where Apple, Tesla are both down this year. Google's underperforming the market. And then the Fantastic 4 are absolutely doing great because the numbers for 3 of the 4 went up a ton. And, Microsoft, obviously, ChatGPT, they own 49% of OpenAI, massive benefit for that for them. So that's why we've dropped those 3 off the list. It's competition issues. Okay, so of the Fantastic or Fancy 4, as we're going to call them here on Squawk, which one do you like the most? You're only allowed to own one.
Ooh, good question.
if I had to own one just from a risk reward basis, I'd probably go with Meta. It was my top pick, one of my top 5 picks last year. The stock, obviously tripled last year, almost tripled. And if you look at it this year, it's also doing well. And the reason why I like it is they're using AI to help drive content recommendations so people are more engaged with the platform. They're using it to drive better ad monetization. And if you think about this year, your segment before was talking about the election coming up. It's going to be the most hotly contested election we've ever seen with tons of advertising. And that's really going to benefit Meta during that period of time as well. And it's growing high teens, but you can buy it at a 24 PE.
Yep.
The entire market's trading at, the S&P is trading at 21 times. So it's got this great combination of low valuation, fast growth, and a presidential election that's a nice kicker towards the end of the year. And so that's why that's probably my top pick.
Preach.
What do you think of NVIDIA? I mean, some people think that this has so much more room to run, and others say it has run too far.
Well, there's a time element and a multiple element to this. So if you go back to the tech bubble, which we all lived through, Cisco at the time was the most valuable company in the world. NVIDIA is now the 3rd most valuable company. But during the peak of that bubble, Cisco was growing revenues close to 60%, but it had a PE of 138 times. NVIDIA grew revenues at just over 100% last year, forecasted to grow 90% this year. Cisco peaked at 138 times. NVIDIA is at 35 times. There's a whole group of semiconductor companies that actually have higher PE ratios than NVIDIA does, believe it or not. So, and NVIDIA is enabling the AI revolution. And don't forget, we never even heard of ChatGPT until November of 2022. That tech bubble, you could argue, started in 1995 when this new thing called the internet, what's that, showed up.
AOL,
and it
baby.
took 5 years for you to actually build to that
Windows
peak.
95.
So this is a year and a quarter or so since ChatGPT showed up. I think you have a long more way to go before you kind of get to that peak level of euphoria, if you want to call it that, because we're nowhere near that yet.
What about Google?
So the more quarters NVIDIA puts up, the harder it's going to be for, and I think it's important everybody understands this point I'm about to make. Listen, NVIDIA has destroyed numbers several quarters in a row now at this point in time, right? The more quarters this story goes on and they keep beating their past quarter and they keep guiding up, right? The more people are going to doubt, the downfall of NVIDIA, essentially, right? And the more they just keep coming in, beating. At some point in time, maybe numbers start to flatline, but you're still maybe looking at 1 to 2 years before numbers flatline in regards to NVIDIA. It's still a bit of time to play out here. And so in this next 1 to 2 years, it's just man, it's hard not to jump on that bandwagon, right? And so the whole downfall of NVIDIA, at some point, I'm sure the stock will get hit hard and it will come down huge. But you still might be 1 to 2 years away from that. And in that time period, NVIDIA could climb to $1,500+ between now and then. So that's just what you got to keep in mind.
The one that I want to get long, we're short it right now because I look at Google and I go, everybody's sort of written them off in this AI race, but they have more data than anyone. The problem is they have this cash cow called search that they're trying to defend. The problem is things like ChatGPT are growing incredibly rapidly, and a lot of people are using that for conversational results instead of tapping through 10 blue links to try to find what you want. You could interact with an AI, and then that'll tell you what hotel you want by talking to you and asking you, hey, do you like a gym? Do you want a 4-star restaurant? And then it'll tell you, well, this is what you should pick. And so I think that's the issue Google has right now and on the YouTube front, things like Amazon launching ads on Prime, that's taking a lot of ad revenue that would have gone to YouTube, or ads on Netflix, ads on Disney. But they also are going to benefit from a presidential election. So that's the one trading at a market multiple that if they can kind of decide, all right, we're going to go all in on AI and, we'll deal with the fact it may kill off some of our search revenues, that's when it gets really exciting because that's the one that's a market multiple but has a huge amount of training data to train AI models. So we'll see what happens there.
Okay.
Yeah, so I thought those were bad examples Dan Niles gave there in regards to the whole Google thing. Like, I'm not going to Chat GPT to find out the best restaurant to eat at tonight. No, okay? I'm still using Google for that. Or I'll use Yelp or something like that, or to look up hotels or things like that. I'm not using freaking Chat GPT, and I don't know anybody that would. Like, you would have to be delusional to use Chat GPT for those sorts of things over Google. Like, that's like, no, you're not doing that, right? And so I thought that was a bad example. There's a lot of research purposes. You might use Chat GPT, academic-related folks, they might use it over Google. But for a lot of these commerce-related things, the things that actually generate money, right, that get clicks and, like, you know, somebody has to pay for the ad and things like that, Google's still the crown jewel there, and they're going to be the crown jewel for years to go in the future. I mean, you know, that's just the way it is. I don't know any other way to put it other than that. That fear around that is kind of a little bit irrational in my personal opinion, okay? Tired of people whining about all that matters is the Magnificent Seven.
Here at Post 9, it's good to see you, AP.
Thanks, Trev.
Steve's got a great point. And then this decoupling of equities from the rate environment, is that all because of Mag 7 or something else?
You know, I was just sitting there watching, thinking, you know, I kind of am partially responsible years ago for starting this garbage of, like, good news is bad and bad news is good when I used to work at Morgan Stanley. And I was sitting here thinking, you know what it is? It's just good news is good news and bad is bad. That's where we are now. You get bad economic news, I think the market's going to go lower. I think if you get good news, we continue to do well. And it's no longer just all about, you know, expectations for interest rates a year from now. We're in this pocket where if we get continued decent economic news, we don't think things are falling off a cliff, I think equities look pretty good. So we're in the normal, you know, God forbid, good news is good for markets and bad is bad. Maybe that's where we are. I know that what doesn't work is good economic news is bad for markets for a long time. I get how you get a little hawkish, you get worried. That's always a 2-day thing. So that's kind of where my head was watching that. Is like, you know, maybe we're just like, good news is going to be pretty good.
So does that require kind of a decoupling of the way we think about interest rates and the interplay and what it means for corporate America? Because obviously with higher for longer interest rates, that means higher financing costs and, you know, it affects discounted cash flows out into the future. So, you know, with cost of capital where it is, how is it that the market can kind of reverse its thinking on that?
Good high-level question.
Two thoughts. One is, I think that thinking is very recent, like the last year or two. Back 100 years ago when I was in school, I thought what I learned is if the economy's good, the 10-year yield backs up and the stock market goes up because they're both representative of things improving. That's actually really where the baseline is. We've gotten this whole, like, Fed-induced, all that matters is the Fed thing that's kind of made your point where everyone's mind is the last couple of years. So I think the second thing is I focus on the biggest 500 companies or so, you know, in the U.S., and you know, this will be dismissive. I'm sure I'll get some commentary, but basically the S&P 500 companies don't go bankrupt. Okay, they both basically, okay, one or two every few. So they have high quality balance sheets. The cost of capital issue you talked about is really more for profitless businesses in biotech, refinancing the capital markets activity. It's not really when you look at the biggest 100 companies that continue to do well. So that's kind of my two thoughts on what you said. And then,
let me push back here. The problem is many of these S&P 500 companies do have massive debt loads, right? And so as you need to do, obviously, some sort of refinancing or anything in the debt markets, your interest rates are just substantially more than they were, 2 years ago, let's say, for instance, right? And so at the end of the day, your interest expense goes up dramatically. And I've seen that for a lot of the debt-ridden companies, their interest expense has gone up epically over where it was a year ago or 2 years ago, right? And if you don't have a big cash balance to offset that with interest income, it hurts your profitability at the end of the day. It hurts your net income substantially, right? And I've seen that for a lot of these big debt load companies, and there's a lot of them in that S&P 500. And so it definitely weighs on these companies' earnings over time.
What I thought was interesting is just the magnitude of the moves you talked about on earnings, right? Where, how much these stocks are up. You didn't mention, I think, Melly, that thing's down. It's like there's just big moves going on underneath. So I'm kind of tired of people whining about all that matters is the Mag 7 and that's all I have to get right. No, there's tons of alpha stuff going on, as you point out in some of the names you went through. So there's some stuff going on.
But are you saying that the Russell is outside of your realm of interest?
No, it's just that it doesn't work unless you think gross margins are going up for the average company. To say that you like small caps means you're very bullish. You think that it's a risk-on trade that happened in November. Why? Because financial conditions eased, and that's all that mattered. Now, for you to believe that we have this broadening rallying, everything's awesome, you're bullish and you think margins are going up for lots of companies and their estimates are going up more than Mag 7.
But you've written recently that you think margins arguably have bottomed.
I think they have bottomed, and that's why I'm bullish on a lot of things, but I think you have to own the Mag 7. I don't see how you can take the risk of being underweight that group unless you're wildly bullish.
What about just the broader macro conditions here? I mean, you've basically said a soft landing kind of coming into view here. Is that more dependent, perhaps, than what we're getting out of the Fed with regard to maybe preemptive rate cuts or something like that?
It's funny. Like, if you go to Trivariate's website, you search on Powell, it says 0 search results. Why? Because I have no clue. Okay, I've worked with really smart people at big firms, and they're not good at it either. It's just really hard and unknowable. And so I think that's why I focus more on the corporate earnings and the big companies. And I look at the big names and their numbers, the biggest 20 U.S. equities, the earnings numbers are up a lot. And that's why I want exposure to it. But, the answer to the question is I think it's mixed. Okay, I think economic activity looks like it could be bottoming. LEIs are maybe a little bit better. But the consumer's slowing, and it's in good but declining position. And I think maybe industrial activity could be bottoming when I piece it all together. Whatever the couple hundred variables we look at, it's okay but declining. That's how I'd summarize the economy. But corporate earnings can be a lot better than the economy for all the reasons we talked about. Those companies that you go through, they have power, they have pricing power, they have cost controls, they have moats on their technology, they grow their net income 15% plus a year pretty consistently. So the reason I'm always bullish on U.S. equities, and I don't like when people say they like EM or they like bonds, is get me exposure to the best 20 U.S. equities. Get me something better than that 15% per year growth. And then so that's been more or less the broken record for the last 10 plus years, I guess. Yeah.
So let me share something very important before we get in this last video, okay? So in regards to the next move for the market overall, okay? Here's how it works out. If we're in a true bull market right now, here's how it's going to work out, okay? So at first, you get a lot of the big dog companies obviously doing very, very well, which would be like the Mag 7, for instance, a lot of the large caps, right? And those stocks have done tremendous over this past, let's call it 12 to 18 months. Now at this point in time, okay? If we're in a true bull market, the next move for this next 12 months will be small caps. The Russell 2000 would go on a pretty insane epic run over the next 12 months. Then what would happen is the smalls would start to slow after that, and then you would have one last kind of move upward for a lot of the big dogs, and then after that last big move for the big dogs, then you have the next bear cycle, okay? So if we're in a real bull market, we have still another 1 to 2 years of this bull market to play out before you get the next big bear cycle. If we're in a, this is legit, right? Because we still got to get a 12-month roll for the smalls. Then after that, you have to get another roll for the big dogs. And then after that, you have let's just call it a market that gets a little ugly there, right? Which puts us all the way out until around 2026. So that's if we're in a real bull market, right? And a lot of that depends on if the economy holds up over the next, let's call it 1 to 2 years. And if the economy holds for the next 2 years, then we're rolling, baby, okay? All right, last video up here. Equities will likely bottom by mid-October. What are we going, bearish?
Management. I mean, let's get a little specific here.
You said it on pitch. That's exactly what our advertising
Of course, and so it works. You're not just going to tell us you're friendly towards stocks. You're going to tell us you like stocks. You're going to tell us how long you like stocks to the month.
Yeah.
Well.
Then she's going to tell us why they're going to sell off into after that and how much they're going to go down.
You're taking her steam.
Because I want you to write this down. You like stocks still where they are right now?
We do.
Till when?
We think that the Fed pivot that started just about 2 months ago with very favorable comments from the Fed and Jerome Powell continues. The breadth of the markets looks very good at this point. You've got more than 60% of stocks over their 200-day moving average. You don't see a lot of ebullience in the market as well. Yes, there are some surveys that look a little bit overbought when you look at 4-week ETF flows. You don't see very big kind of powerful moves coming into the market with cash coming off the sidelines. And then some of the risks have also dissipated, right? Just a month ago, the markets were pricing in 170 basis points of Fed cuts. They're only pricing in about 90 basis points at this point. So some of the risks that you had, which were kind of really getting some feverish in the markets, have kind of backed down a bit. which makes us much more optimistic.
Okay, but then what's this pivot point? When does it end?
So we've seen this. Well, we've seen this pattern.
I have a pen here, a calendar.
I'm not that good.
June. You got it. That's what you said. It's what you told our people. It ends in June.
So
because of the election.
This is what we've seen in previous election years.
Okay.
Not all election years, but we could see this setup happening again.
And it goes down 10%.
The market.
Answer the question.
All right, go ahead.
Goodness.
Go ahead.
Everyone's had too much coffee today.
No, I don't. I can't have caffeine.
Really?
GERD.
This is like you?
Yeah.
Yes. Did you not know that?
I didn't.
Yeah, I require
She's
coffee.
like, yikes.
Continue on.
Sit
Like
here.
5 cups, he does.
Okay, I don't need that many.
No, I don't do 5.
But I think
You
the real
would.
issue.
They kept bringing them.
2 or 3.
Well, you do 3.
Okay, back on task. Back on
warning.
task, everyone.
We have,
Okay, go ahead. All right. June, down 10%.
No,
into
so this
the
is what
election.
I
happens.
got my pen.
We saw this happen in 2000. We saw it happen in 04. We saw it happen in 16. A lot of times markets have a lot of good steam into the election, and right around the markets don't pay much attention to it right now. You haven't had Super Tuesday. Yes, we're paying attention to kind of who the front runners are, but it hasn't really come front and center to the market's psyche and the market's attention. That usually starts to happen right at the end of primary season, right around June, right? And then markets kind of start to wobble because they say, well, we're not sure who's going to be president. And generally during the summer months, you'll get some agita. You'll have some type of peak to trough decline in equities that gets everybody a little bit nervous. And then usually 3 to 4 weeks before the election, it's generally decided that there's going to be a winner. We will have a new U.S. president, and the market tends to find
So are you
its
supposed
footing.
to play this for the next couple months?
So let me be very clear about what she just said there, okay? And do I think that could play out? I think that's very realistic. If you forced me to make short-term predictions on this market, which short-term for me is anything less than 12 months, I can see that happening. Market continues to roll, all into sell in May and go away, as the famous expression goes, right? Maybe we have a tough summer. A lot of worries out there, maybe a lot of rotation, maybe a lot of profit taking, right? Let's say this market keeps rolling, into March, into April, and, NVIDIA's, $1,200, $1,300 at that time. Meta's $550 to, maybe $600. I think there's be a point where some people would say, you know what, I'm going to go ahead and take a little off the table, sell in May and go away. And I think that could definitely play out. And then we kind of have some, a weaker summer, which is very, that's not uncommon at all to have a weak summer. The interesting thing I do think that could be a potential, though, is as you get some of that selling, I think there could be some people that positioned even small caps during that time, which could be very interesting because that could be big money selling out of some of those S&P stocks. And so the market looks like weak at that time, but maybe that money's rotating into some of the smalls, and then that big money's rotating into small caps, which, makes them go up quite substantially. So that's always a potential as well. So what you just played out there, I think that's pretty realistic. Would I bank on it? No, but I think it's a pretty realistic scenario.
Well, hang on a second.
Make sure that you're going to, and then make sure that you're out for the summer?
Look, don't forget, at Voya, we're investing for retirement money. My horizon is 40 years. I'm just telling you what we think is likely to happen because you've got a very big upcoming geopolitical event, which has tended to cause some weakness in equities. We, as long-term investors, would invest through it. But I would say that you're likely to have a little bit of indigestion because elections generally don't go unnoticed by the market. They do tend to cause a pullback, and they do tend to cause some nervousness.
This election is a little bit different than,
to say the least.
Than most elections. So you're investing for someone retiring in 40 years. So this is almost customized for me.
Yes, just about.
Andrew?
Yes. For 40 years, I heard.
40 years.
I caught it. I am listening.
That's very nice of you. To
I do work hard for you.
That's really nice that you were able
Okay, anyways, that was good stuff there, and I think our playbook there is pretty realistic, okay? All right, guys, appreciate you joining me as always. Thanks so much for being here. If you're looking to join my Patreon, there'll be pinned comment down there, support my content, plus get to see the stocks I was buying here today. I bought 4 stocks in that portfolio, see the stocks I'm buying in future weeks, plus get access to that Discord chat in there. And people that are already part of the Patreon and you're hitting 5 figures in your portfolio, make sure you submit your application. I'll send you over your 5-figure award, baby. There it is. You can go into the Hall of Fame, all right? All right, guys, much love as always, and have a great day.